Michael Burry, the Wall Street titan who famously predicted the housing bubble, now has his sights on something even bigger. Will lightning strike twice? Tune in as I dissect Michael Burry's latest jaw-dropping move, a high-stakes bet against the QQQ and the SPY. The markets are trembling, and you are about to find out why. What's up, strangers? Welcome to the Wealth Game Nation. My name is Vedo, and I'm here to help you better understand the Wealth Game and become part of the Wealth Game Nation. As I aspire to be a great investor, I am putting myself publicly to the test. I think that all finance creators should do the same and share their investment publicly. As that is my intention, I started sharing my brokerage account regularly in real time without any fancy spreadsheet or gimmicks. This is my own personal brokerage account. As you can see, the current stock value is 90,700 euros. I hold 18 different investments, 14 in individual companies and 4 ETFs. If I scroll down to the performance, we can see that around 3,000 euros is in profits. If you want a review of my full stock portfolio, check out my portfolio reveal video. The link is in the description of this video. Now let's look at what has Michael Burry been up to lately. This article by CNN Business reads, Michael Burry of Big Shorts fame just bet 1.6 billion on a stock market crash. Further down in this article, it says that Burry is making his bearish bets against the S&P 500 and the Nasdaq, according to the Securities Exchange Commission filings released Monday. Burry's fund, Scion Asset Management, bought 866 million in put options, that's the right to sell an asset at a particular price, against the fund that tracks the S&P 500, and 739 million in put options against the fund that tracks the Nasdaq 100. We will get into the details of put options just in a moment. It also says that Burry is using more than 90% of his portfolio to bet on a market downturn, according to the filings. This is also not true, and I will explain you why. If we shortly look at what is short selling, basically the short seller borrows shares of a certain company from a broker, and then the short seller sells those shares on the open stock market right away. In this example, the short seller bought 10 shares and sold them right away for $500. Then he waits the stock market to go down. He then buys back the 10 shares on the open stock market for, let's say, $400. And then the short seller returns the 10 shares of that stock and keeps the delta, which in this case is $100. Sounds simple enough, right? There are other things to know when you're doing options trading. The option, or also called a contract, is always one option represents 100 shares. So if you have 10 options, that means you hold a contract for 1,000 shares. Then there's the strike price. The stock price would need to reach this strike price in order for the option holder to be able to execute that option. For example, if the stock price is $100 and the strike price is $70, the stock would need to drop to $70 in order for the options holder to be able to execute his right to sell that option. During all this time, there is something called a premium that the option holder needs to pay to the broker for simply borrowing his shares. The last thing that you need to consider is the expiration date. The expiration date is sometimes in the future, and if the stock price drops to $80 and the option expires, then that contract is useless. So in Michael Burry's case, we do not know what is his strike price, we do not know what is the expiration date, and we do not know how much premium is he paying. If the premium that the option holder exceeds the drop in stock price, then you're still losing money. If we stay with the same example and we say that the strike price is $70, but the expiration date is further out in the future, and eventually the stock drops to $70, it can happen that the short seller has paid $40 in premium, therefore he will be at a loss of $10. So those are all different things that need to be considered. Then there is also the possibility of the market going up. If the market goes up, then the short seller has to have enough funds in his brokerage account to cover the increase in price. If the stock price keeps climbing and the short seller runs out of money to cover the increase in price, then he gets margin called. That's why I think that the article saying 90% of his funds, it's not correct. He's basically paying premiums and making sure he has enough funds to cover for the potential increase in stock price. Now let's look at what did Michael Burry do in the past? How did his shorting so far go? If you look at this article from Wikipedia, we can see it says in 2005, Burry started to focus on the subprime markets. Throughout his analysis of mortgage lending practices in 2003 and 2004, he correctly predicted that the real estate bubble would collapse as early as 2007. Remember these years, 2003, 2004, 2005, and 2007. During his payments toward the credit default swaps, basically the premium, Burry suffered an investor revolt. Basically, his investors were not happy that their money is being used for premiums. And this is money that you do not get back. Eventually, Burry's analysis proved correct. He made a personal profit of 100 millions and a profit for his remaining investors of more than 700 million. Scion Capital ultimately recorded returns of 489% net of fees and expenses between its November 1st, 2000 inception and June 2008. The S&P 500, widely regarded as the benchmark for the stock market, returned just under 3%, including dividends over the same period. Here it's important to note that between November 1st, 2000 and June 2008, there was also the dot-com bubble in 2001, as well as the housing market crash in 2008. So this is a very subjective time period to look at it. So this has worked out for him. However, further down in the article, it says that Burry initiated short positions on Tesla before or around early December 2020. He was saying that my last big short got bigger and bigger and bigger, and taunted Tesla bulls to enjoy while it lasts. In October 2021, after a 100% rise in Tesla stock value, he revealed that he was no longer shorting Tesla. So throughout history, Michael Burry is known to try to short the market and what he believes are overvalued companies. That was Wikipedia. Now let's look at the S&P 500 for the last 20 years. Remember, the article says he started to investigate in 2003 and 2004. Then he started short selling in 2005, and he predicted that the market will collapse in 2007. Since 2003 and 2007, from when he started investigating and started short selling and his initial prediction, the market went up almost 90%. Then the actual market crash was happening around October 2008, and Burry closed his short position and closed his fund completely. Between October 2010 and actual bottom of the market, there was almost 30%. The market bottom was in March of 2009. So between the time that Burry started investigating and the actual bottom of the market, 6 years have passed. And he was predicting a market crash early 2007. If the stock market crash would have happened 6 months or a year later, today nobody would know who Michael Burry is. That is because his fund would have been depleted, paying for the premiums just to hold the options. So yes, he did predict the 2008 crash, same as he predicted everything else. He predicts 5 crashes a year based on one or the other factor, but the stock market and the world economy is too big of a beast to be manipulated by 1 or 2 factors. There are too many variables at play at all times, and nobody can account for all the variables. Let's see, why is Michael Burry shorting the market now? The company's earnings are going down, interest rates are up, inflation is sticky, recession is looming around, and so on. As my brokerage account only shows the absolute values of my portfolio, I have created a replica of my portfolio in Google Finance. Here we can see that at one point the S&P 500 has gone 20% year to date. The Nasdaq for the same period year to date has gone up 45%. My portfolio has gone up almost 49%. That was at the peak. Today the market has already had a pullback a little bit, and the S&P 500 is at 15% and the Nasdaq is at 37%. My portfolio is around 40%. So given all the data that we have, that all the macroeconomic factors are not very good at the moment, and the stock market has been going up constantly this year, it is not very difficult to say that everything points to a correction in the stock market. Another indicator for this is the S&P 500 PE ratio. The current PE ratio of the S&P 500 is at 25. That means that investors are paying 25 times future earnings. The average of the S&P 500, however, is 16. So there is a huge difference between the historical average of the S&P 500 based on the PE ratio and today's current PE ratio. That is also an indicator that there is a high possibility of a market correction. But there's always a possibility of a market correction. Same as there's always a possibility of the stock market going up. Lastly, let's look at Burry's investment philosophy. I'm sure many of you know this website, Dataroma. This is a website where we can see what the super investors have been doing with their stock portfolios. 45 days after every quarter, the super investors have to file something called the 13F filing to show what was their activity for the past quarter. Here it's also important to note that a quarter is 3 months and we get the data 45 days later. That means that if an investor has bought something at the beginning of the quarter and we get the information about it 45 days after the quarter ends, there's potentially up to 4.5 months of lag in the data. Even by the time the 45 days have passed, there is already half a quarter gone, and that information is by then already outdated because the super investor could have already sold out of that position. Now let's look what Michael Burry has been doing lately. Michael Burry's fund called Scion Asset Management has 111 million in assets under management. His portfolio also holds 31 different companies, and this is dated 30th of June 2023, basically the Q2 of 2023. 31 companies is quite a lot of companies to be invested in. This is a lot of diversification. Without going into the details of the holdings, we can see that there are a lot of buys, and the word buy basically means that this is a brand new holding. Adding means it's been added, and reduction, obviously reduction. In this overview, we don't see what he has sold out of, but we will look at that in a moment. We can see there has been a lot of buys into brand new companies. If we look at the buys, all these buy, all these buys are new companies with a couple of additions. If we look at the sells, we can see only 3 additions and everything else has been sold. If we look at Michael Burry's activity over the last few quarters, we can see that there is a lot of activity. Actually, this was just one quarter. Q1 2023, also a lot of activity. So I don't think it's very wise to follow anybody in their investments, especially not somebody who is an active trader like Burry is. You cannot follow his logic. You cannot follow that strategy because you don't know what the strategy is. To me, it seems that Michael Burry is a swing trader or a momentum trader. If we scroll back up and look at the history of his fund, only a year ago, in Q2 2022, his portfolio was only 3 million and it was in the Geo Group, one holding. 1 year later, he has 111 millions in his portfolio with 31 companies. So those are huge swings. If we would look at another extreme example, such as Charlie Munger, Warren Buffett's right-hand man, who is worth over $2 billion, his Q2 filings shows that he has only 4 stocks. He has a portfolio value of 163 million, and the column for the recent activity is completely empty. That means he did not do anything in the last quarter. If you look at his activity, this is his activity for the last decade. Since Q4 2014 till today, he has done 6 trades. That is because he has a completely different investment philosophy, which is invest in great companies, let them grow long term, and do nothing. If you look at the history of Charlie Munger's Daily Journal Corp, we see that he has had up to 5 different companies in his portfolio. This is the opposite of diversification. In conclusion, I would like to say that I believe that when it's all said and done, Michael Burry's long-term performance will be nothing special. I will be bold and predict that over the long run, Michael Burry's performance will be mediocre at best, and dare I say it, in the end, he will underperform the average of the stock market. The man has predicted 10 out of the last 2 crashes. They say, even a broken clock is right twice per day, or even a blind squirrel finds a nut once in a while. And when I think of Michael Burry, those are the 2 phrases that come to my mind. He will never be in the same discussions as Peter Lynch, Warren Buffett, or Benjamin Graham. The man is a genius, but also a gambler. He finds rationale and patterns in the data and then bets that Mr. Market, the allegory created by Benjamin Graham, will see it also the same way and react accordingly. And we all know that Mr. Market is irrational, and in the short term there are extreme swings in the market's price, which are sometimes worlds apart from the actual state of the market. This reminds me of a quote by Benjamin Graham where he says, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." That means that nobody can predict the stock market in the short term, not even Michael Burry. However, in the long term, the stock price will reflect the actual fundamentals. Tell you what, since I'm in a great mood, I will leave you with a short clip from my favorite investor, Peter Lynch.
What you're saying to people today about the future of the market over the near term is what? What's your feeling?
We can take
I got to buy business.
We can take a coin out and flip it. I have no idea what the next 1,000 points is going to do. The next 6,000 points is going to be up. The next 14,000 points is going to be up. The next 20,000 points is going to be up.
But you don't know where the next 1,000 is going to be. It
Nobody
could be down,
does.
could be up.
Nobody does. And it's futile to try and guess it. Corporate profits will be a lot higher 10 years from now. They'll be a lot higher 20 years from now. That's what you could rely on.
That's a prediction you can take to the bank. He has been right every single time ever since this clip has aired in 1997. So I will do me. I will continue to learn about investing, concentrate on the fundamentals, learn from the greats, which does not include Michael Burry, and I will search for great opportunities and always think long term. There you have it. That was my review of Michael Burry's latest moves in the market. I hope you found this video informative. If you have any questions or comments, please leave them down below. And if you're not already subscribed to my channels, please hit the subscribe button and share this video with your friends and family. I will do my best to create regular videos with updates of my portfolio. I will do more fundamental analysis and review other companies, their earnings, other investors' buys and sells, and everything around investing. Thank you so much for watching, and I'll see you in my next video.